Hey, hello, folks. Welcome to Pro Trader Strategies. My name's Eric Wilkinson, and this is going to be your option guide to trading futures, options, and stocks with this type of trading strategy. We're going to be cracking the code on these options. I'm going to show you folks what the most important thing is that you guys should be looking at before you ever start trading options. And by the end of this, I think you guys will have a solid understanding of when, where, and why we would implement specific option strategies into our portfolio, mostly based around whether we're buying or selling options. And in this particular one, we're going to be buying options. As a matter of fact, this is going to be the long straddle. This straddle is going to try to take advantage of a pop or drop type of move. When you're kind of sitting there wondering what is going to happen, especially right now in an economy and the fluctuations we're seeing in the markets, this could be a great strategy to implement. I'm going to go through when, where, and why we would implement the long straddle. But before we get there, I want to really break this down, because when I'm teaching these strategies, I like to build from simple concepts to real life examples. So with that said, let's put this on the shelf for right now, talking about the straddle. We'll get there. First off, I want to talk about peeling back this onion. And if you guys have ever seen this or watched one of these videos before, you guys know I like to relate this to data transfer. That's what's going on here. O's and ones is the fastest, most streamlined way to transfer data. But when you're going over to the option page with all the calls and puts, it kind of looks like this, or like you're looking at the inside of an Air Force jet, and that is the cockpit with all of the bells and whistles going off at any given time. So let's take a freeze frame of this, peel back this onion, and look at these options and what they're really telling us, okay? So it's all O's and ones. There's layers of it, but when we freeze frame it, it doesn't look nearly as intimidating. And that's what I hope to do for you folks through this video, is build from the simple concepts, peel back this onion, and by the end of it, it's going to seem very logical as to why we would implement these strategies at any given time, all right? All right, so first off, one thing everybody always has an opportunity to do is talk to a financial advisor as soon as you start making money, right? Or just talking finances and stuff. A lot of folks will always ask others, what's the best investment one can make? And folks, comment over there in the comment section. We are on both YouTube and Facebook, so please comment away. I'm going to keep my eye over there, making sure you guys are all clear of concept. But when we're talking about investments, what do people normally immediately come back with for your best investment advice? I always hear everybody is talking about go out and buy a house. As a matter of fact, Rockefeller once said that dirt was the best investment. Why? Because they weren't going to make any more of it. And it's actually a really smart concept, right? If you buy something where there's a finite amount of it, well, then there's only that finite supply. And when you expect demand to rise, then those prices have to push higher, right? We're seeing that with crude oil right now, right? We aren't opening up any more operations, no more fracking operations, no new drilling operations, no new permits. So basically, we are currently stuck with a supply constraint, all right? And demand is trying to drive higher. That's pushing prices. Similarly with houses, right? We've actually just gone through a short fluctuation where we saw housing supply really plummet in relation to the demand we were seeing. So most folks will say that the price of houses will always go up, right? But if you go back in time, basically to the .com even, which was in 2000, we saw housing prices drop for sure on that .com crisis. And then they rebounded, right? We kind of rebounded all the way until the financial crisis in 2008. We saw a pretty massive, scary sell-off. As a matter of fact, we might have even dropped down to those levels that we saw in 2000. Recovering quite nicely. Pandemic, we even saw a little bit of a dip. I saw some people right at the beginning of the pandemic, they were getting out of the urban areas and basically moving to the suburbs. one lady here in Arizona bought a house for $600,000, sold it for 1.5. All right. So that's the type of, we saw a little bit of a dip there and then almost went parabolic to the upside with the housing prices as of recently. And then now we're talking about what is going in the economy. We're seeing inflation. Well, housing prices are definitely a reflection of inflation here. So the Fed tries to raise interest rates. We just saw them raise interest rates yesterday. They raised the interest rates to try and get you and I to slow down on our spending. All right. Not to just go out there and buy your Starbucks or buy an extra dessert and stuff. We're thinking now we need to become savers. And what happens when you start saving, right? Well, there's not that drive to the demand aspect to whatever you're buying normally. So those prices hopefully will come down. Now, I've said time and time again, we need to see oil prices come down before we're ever going to see this inflation ebb. But the product of interest rates and your income, okay? Interest rates and your income. We could even see this as a relationship to price and percentage points. But when interest rates start increasing, you guys know you're paying more to principal, or sorry, paying more to interest than you were to principal now, right? Or at least when we were at 0%, we were almost everything we were paying off was going to principal. Very little went to interest. But as interest starts increasing, that package, if you and I are only able to spend, say, $1,000 a month for our house, because really what you should be looking at is 25% of your monthly income should go, no more than that, should go to buying your house. So if you kind of think about your own budget, we have a finite amount of money. We should be budgeting towards that. Well, if interest rates rise, we're paying more towards the interest than the principal, but we can still only afford that $2,000 a month or something, right? So what happens is then that causes houses to come off a little bit because we can't afford the same price house. You might be able to afford a, let's say, a $250,000, let's just say $300,000 house. I think that's right around the national average, $300,000 house. Well, as these interest rates increase, you might only be able to afford a house that's $275,000, okay? Because now you're paying more to interest rather than principal. So that has a tendency to get the housing prices to start dropping. So we don't know where that drop is going to end ever, right? We just know that where prices now. So while folks like to tell you a house is the best investment, it kind of depends on when you got in, right? If you got in at the high, that might not necessarily be the best investment, or it's going to take a while before we see that type of recovery. Listen, folks, we were hearing that, you know, the overnight rate's going to go to 4%. We haven't seen that since the 90s. That means that your mortgage rate is probably going to be 6 to 8%. All right. And we've been getting used to 3 to 4% for 30 years. That's pretty crazy. So housing, yeah, I think it's a pretty good investment, especially I would never say don't go buy a house, except for right now. I might say hold off, maybe go buy an RV because I think you can get a good deal on one of those and then layer into your house a little bit later. So it's not always easy to look at a housing price because while folks are telling you to go out there and buy a house because it always goes up, we know that price does drop. So depending on your timing is really what is going to determine whether or not you did well, right? And if we have this market crash, well, everybody could be a little bit bent because they bought right after the pandemic at those highs. So it seems easy for folks when they're talking about buying a house. They always say, yeah, you just go out and buy low, sell high. And if you bought a house, it's not that easy because when you're buying a house, you're always wondering if you're buying the top there. So you really don't ever really know when it is low and when it's high. I mean, it's a novel idea. It's so simple. It seems stupid. Well, it kind of is because it's not that easy. So really the idea is when we're looking at price and looking at charts, it's a little bit easier for us to kind of see sideways trending markets more so than when we see vertical or bearish type of charts, because it's a little bit harder for the untrained eye to really find those support and resistance levels, or that channel that we draw in there. That's not a very good channel. I would draw that channel a little bit more like that. I like it to break through just a little bit, kind of like this when I'm setting up my charts. But the brilliant thing is, when you're looking at sideways charts, your eyes immediately align with the support and resistances, almost like that. It's kind of like we see faces in different aspects. So you might look at a wall with like a texture and say, oh my God, is that a face? Or looking into a cloud, right? A piece of toast. We see faces there because our eyes are trained to see faces and to see patterns. And it's much easier to see a horizontal pattern than it is to see a vertical or a negative one. So what we try to do often with trading stocks or futures or even ETFs is try to find where these levels are, where folks find value and then sell or expect it to be overvalued and start selling, right? So what we want to try to do is find markets that trend sideways to give us a clue, because when we're watching houses, we don't know if that is a high or a low. If we're looking at stocks, we don't know if that price is actually priced in very well, right? Because these financial folks are always looking at stocks and saying, okay, well, they're going to make this much this year. Based on that, going forward the next 10 years, we're going to base a multiple, because they're going to obviously continue to increase in value, right? They never do anything wrong. So they obviously need to have that multiple going forward to catch up with that market that's going to constantly be moving higher. But what's happened recently, we're seeing these prices come off. And that's because that forward guidance is not so rosy right now. So they're trying to roll back what they think these multiples are. And that's causing housing prices, that's causing stock prices to come off a little bit, because now our forward guidance are looking forward. That crystal ball is looking a little bit gray going forward. So we're seeing a little bit of a pullback. So when you're looking at stock specific to try and buy low, sell high, that's a very tough row to hoe. We can come up with our directional moves. We don't necessarily know exactly the price of the bottom or the price of the high, but we can see that the market's starting to roll over a little bit. We could sell into that, take advantage of a downside move, or if we see this market start to turn around, take advantage of the upside. Now, with that said, though, you don't always know what your pricing is in relation to what everybody else perceives pricing, right? That's difficult. But one thing we do know is with options, folks, options give us a tell when they're cheap or expensive for that matter. We can look at a chart of options that looks similar to this, because volatility for each individual underlying. I'm not talking about the VIX. Yes, the VIX is skyrocketing right now. Most folks would be sitting there saying volatility is everywhere. And I'm not going to try and split hairs here and say it's not, but it's not really everywhere. There's stocks that are actually making gains in this market sell-off. So volatility, though, will tell us if the option prices are cheap or expensive. All right. So that will tell us if we are going to be buying options or selling options. All right. We don't want to buy high and sell low. Nobody does. So when we look at a chart here, we're going to see charts, a lot of charts, and we're just going to try and like draw in a few lines. And then we know based on the rules of options. All right. One of the rules of options is, and it's very simple. It's kind of like geometry. You just got to remember a couple of these rules. Everything is assuming an advancement. All right. When you go over to that option montage page, everything is on the expectation of a higher move or an advancement, I'd like to say. That means for every dollar move higher or every day that goes by, in volatility, we're looking at an option montage is Vega, right? And listen, folks, Vega is just implied volatility. All right. That's all Vega is. It's just a fancy name for volatility, or more specific, implied volatility. So implied volatility is a forward-looking metric. So it's on the expectations of what's going to happen going forward. So what the rule is, it's based on 1 percentage point move advancing higher. All right. So if the volatility goes higher, increases by a percentage point, then we would see prices kind of be leveling out around there. You know, you see volatility up at this level, I immediately know that prices are basically the most expensive they've been in the past 52 weeks or so, right? So we can take advantage of that by selling options, collecting that big juicy credit, right? That's when we can tell we're selling high and buying low. I'm not talking about how you come up with your directional assumption. What I'm talking about is you've already come up with a directional assumption. You've got a pretty good feel as to what the markets are going to be doing for this underlying. You come up with a bullish market move, you need to immediately go over and look at this volatility chart and see where we are in this line in the sand and between those two brackets there. All right. Because if you expect volatility to continue higher, well, that means you want to buy, right? If you expect volatility to move higher, you want to be buying. And if you expect it to go lower, you should be selling options. So we can see that there are points that we could be easily seeing where we could be selling options. All right. And we can, on the flip side, see where we could be buying those options. All right. When it comes back off or close to those lines. The optim montage, I'll get to that in just a second here, Mikito. We'll get to that in a second. I want to build from this first, though, but good question. All right. So if we know every percentage point higher means that the prices in the options are increasing, then we know that when it's at those extreme levels, those prices are the most expensive we've seen. Now, some folks will try and split hairs here and argue with me, hey, listen, if I'm looking at the July contract versus the September contract, those September contracts, which are much further away in time and much longer duration, those out there, yeah, those are more expensive. And the reason why, only reason why, is because of your buying that time. You're buying time to be right. So that pricing adjusts only due to the time that you have left for that option. But at any given moment, the underlying doesn't trade a penny higher or lower. A day doesn't go by, not even a minute. And the what is it? The other thing I was thinking of, volatility just increases 1 percentage point. We would actually see those prices in the option montage increase by that coefficient. And when we get there, we'll see how that works. I'll break this down real easy here in a moment. But it doesn't matter when we're looking at this underlying what it is. This could be ABC. What I want to know is we can see that ABC has a pretty good line resistance area. I would say it's probably right in and around this area here is where we would find resistance. And I would say the support level is probably somewhere right around in there. Okay. Yes, it does break through on certain occasions. And I don't mind that. All right. I don't mind seeing some of these peaks breaking through and these troughs break through. The reason why is because that gets my alarm going. It's like, all right, we've broken out of this little area. I need to start focusing because this underlying is, showing me that the options are really cheap. If I come up with an assumption in it, then I want to be buying those options. So when we see something down here, that would be obviously the level that you would be thinking buying. Now, it doesn't mean that it can't continue to go down. We can't, in volatility, catch the very low tick, just like we can't do it in stocks. But what we can do is tell these are pretty cheap down here. And when it gets down to this area, I do expect to see volatility to start to rebound. Another thing I say is when you draw those lines in, draw a 50-50 line. For me, I have a bit of a higher risk tolerance trading regiment than most folks do. So you could even split it into quarters. I don't mind. It depends on your risk. If you're newer to trading options, I would suggest starting out at the extremes. So what I like to say is these are the sell zones, right? And these are the buy zones. If you, like I said, if you have a lower risk tolerance or you're just new to options trading, make this your buy zone below that quarter. So you're only getting those quarter areas. So you're getting the most extreme. You're going to have to be patient. You're going to have to wait on some opportunities there. But if you check it out with the 50-50 line, you're going to be able to get more opportunities. All right. You just know that when it's above that 50-50 line, that's when they're starting to get expensive. You need to start paying attention. You see that roll over, that's when you want to be selling, because you sell high. You get that volatility to come out. It doesn't really matter what the underlying is doing. You got the volatility helping you. As a matter of fact, there's been many occasions where, as a trader since the 90s, I've seen where during especially the .com crash, people were buying some calls ahead of that .com crash. And as the market was free falling, people were panicking and buying options, buying calls, buying puts. Some people were buying calls on a spec, but buying options, just get me protection. All right. Well, what happened there? That drove prices higher, because if more buyers are coming in, that drives prices higher. That's where the volatility comes from. We saw people that were buying calls with the market free falling actually, get out for a scratch or even make money, or at least not lost as much as they should have, right? They didn't just lose everything. They actually were able to get out for some money. So we want to make sure we take advantage of these levers and pulleys in the markets to make sure that we're getting in at the right time. Go to another one. This doesn't matter, right? It doesn't matter if this is PDQ, if I'm trading PDQ or IBM. All right. What we want to do is find what this underlying is and where it's at. You can see that this one gets about as high as like 47. Let's say it's as low as 25. If we look at the last one, we'll see that these are a little bit different. This, well, maybe it's right around the same. It's pretty close. Low here is around 20. The high is right around 45. So those are pretty close. But what I want you to understand here is you have to compare apples to apples. We do not want to compare apples to oranges, meaning I don't want to look at Apple's implied volatility and then look at Tesla's implied volatility and say, Apple's pretty cheap over there. No, we can't, because volatility in Tesla is usually much higher than just about anything out there. All right. So you have to look at Apple's implied volatility in accordance to Apple's, because it will have a tendency to have its own particular range there. Again, you can stretch this out, go back, put some lines in there like I did on this one. And I based these lines on what's currently going on. I took some of the more extreme levels there. But then what did I do? I just right-clicked on the top line, left line, extended them out to the left, do a shot to extend my time frame. And lo and behold, look at that. Even pre-pandemic, this underlying stayed within a pretty good range in accordance to whatever this underlying is. So I encourage you guys to look back, look at this data, check out your implied volatility, see how far back it goes, see if it's still consistent. More times than not, you are going to see that it's staying within a pretty darn good range. Now, pre-pandemic, not really a whole lot of volatility. We were in the teens in the VIX. So now we're up in the 30s. So we could see that, yes, we are at like an incremental higher here. As a matter of fact, somebody was on here. I think it was, his name was it Ryan last week, was asking about some of these things that I'm going to talk about. So hopefully you're here today, Ryan. I've got some examples that we were going to be talking about. Again, we can draw these lines in based on near term, what's happening, but you draw those lines out and look at that. It really follows true. Again, I'm just showing some random ones here. I'm not cherry picking anything. This one is the one I want to look at, all right, because this is what I want to use for the example. One of them is it's got that paradigm shift a little bit higher, okay? It also, I think it was Ryan, has skew in the options. We'll talk about that a little bit more in this one. Last week, I didn't have a very good example. This week, I think I got a good one for you. So hopefully we can go over that. So we can see here, it's in this range as of the last 6 months. Now, I have script that goes over on the platform that does the implied volatility for the last 6 months. So when I'm doing mine, you can see over here that I have it in my watch list, implied volatility percent for 6 months, because I really like to look at all of it, but keep in mind, especially right now, that time frame with volatility could fluctuate. So I want to look at the last 6 months as my data point. I do want to always remember all of the other stuff. If I've had that paradigm shift higher, is it going to go back to the full range? This one that we're going to be looking at today, I don't think it is because of what it's correlated to. Let me get this over here real quick. And that's really what we're going to be talking about. So again, here is that, stretched it out for that 3 year. You can see where I've got my lines that I'm working with now. Well, that paradigm has completely shifted to another level. All right. Will it revert back to that? I do believe it will sometime, but not until the thing that this is correlated to, which I might as well just talk about it. Stop being cheeky. Folks, this is for NVIDIA. You can even look at NVIDIA on your charts, figure it out. NVIDIA is basically beholden to Bitcoin. So if you wanted to get involved in Bitcoin and didn't want to deal with those massive moves, well, you could go over to something like NVIDIA, which is beholden to the miners, all right? Their products go into the mining operations for these cryptocurrency guys. And so as price goes higher, the theory is NVIDIA is going to get an influx of buys because folks are going to be doing these mining operations. If Bitcoin free falls and especially goes below, I think it's like 5,000, maybe it might even be higher, it might even be 10,000, that those miners can't make money. It's probably 10,000 now with a higher energy prices across the board everywhere. So I would have to say that it goes below 10,000. You're going to see a panic at the disco because these folks that are miners are going to be losing money. They're going to be spending so much money on electricity and not getting a coin kicked out to them fast enough at a price that makes up for all of that. Then you're going to see these folks start to sell all these mining operations and nobody's going to be buying new chips. So we could easily get a pop or drop scenario here. The scenario for the drop I just kind of gave you. For the pop is, listen, as people are panicking in the equities, there has got to be a place where people are going to park their cash. Generally speaking, that's gold, but more and more people are saying that the newer generation would rather park their money in Bitcoin. That's the inspiration or the thesis for the upside rally, is that people are sitting on cash right now. I've been talking about it in the daily market commentaries that I do in the morning. So, you know, if you guys haven't subscribed, make sure you hit the bell because those morning ones are unannounced, unlike these where we announce them well in advance. And I hit the nail on the head with the timing to come in, hopefully most of the time. Those morning ones, it's really economic data pops up. I want to talk about something. So it's scheduled for like 9 o'clock Eastern in the morning, but I'll come in anywhere between 5:30 and, anywhere between probably 8:30 and 10. Okay. So keep your eyes out for that. Make sure you subscribe with the bell because those will tell you unannounced videos. All right. So volatility drives price. We've beaten that horse, right? We can see that when volatility is at extreme levels, that price in the options is expensive. I'm not talking about NVIDIA's price. I don't care about NVIDIA's price. I've come up with my directional move. Now I have to come up with what my strategy is, right? I've got a pop or drop strategy. I believe that with NVIDIA, we are either going to pop back higher, much higher. I think it would even blast through 225 if we start really seeing Bitcoin move. And then to the downside, listen, we could see this go all the way down to probably even just 75 to 50 area. That was what NVIDIA was really kind of doing before the Bitcoin craze. So once you've come up with your directional moves, I'm looking at this chart. I've talked about my thesis of what I think with Bitcoin. It's either a pop or drop moment here. We've got an earnings. It's a couple of months away, right? And I would say if this is my line in the sand for volatility, that volatility is actually kind of right in the middle. I'm expecting if we get these big moves happening, I'm going to see volatility spike. So if I'm expecting volatility to spike, what do I want to do? Do I want to buy or sell? Just throw a B or an S in the chat window there. Do I want to buy or sell if I expect volatility to go higher? Well, volatility, that's right. Volatility is what's driving the price. So if volatility goes higher, I would be expected to be a buyer of options based on whatever assumption I came up with. So let's simplify this real quick with options. I'm going to go over a couple of things before we get into the option montage. And we'll talk about this real quick. I don't know why my pen didn't come up. All right. So a couple of things before we get on to the real nitty gritty here. All right. I'm going to talk about Delta. All right. Delta is one of the options that everybody pretty much knows. Yes, my dogs do know how to open the office door. All right. So Delta is one of the ones that everybody knows the best, right? And Delta tells us that it is, well, one of the things that we know is that it's based on an advancement, right? Everything in here is based on an advancement. So Delta is based on a $1 increase, all right? So when that $1 increase happens, all of the options are going to adjust according to their coefficient, whatever that number is in the options, okay? So let's just say at the monies. If XYZ, if we're talking about XYZ stock, let's just say it's trading at $100 to make math easy, all right? Now, if XYZ stock is trading $100, we in the options world call the 100 calls and the 100 puts the at the monies, all right? That makes sense, right? The stock is the money. We are at the money. The 100 level strikes is at the money. Now, we could split hairs and talk about whether or not the I just lost my train of thought there. $100 stock increases. So the at the monies are going to have a 50 delta. All right. So, oh, I know what I was going to say. We could split hairs on at the money being the 105 strike or the 95 strike. That's pretty close to where it's trading. A lot of people will kind of bundle those in together as the range there. All right. So the at the monies come with a 50 delta, generally speaking. The gentleman last week was saying, what do you see sometimes when you see that 50 delta is way out of the money? Well, what we see there is skew. And I will talk about that here in a little bit. But general theory is the at the monies, if it's trading exactly 100, the calls and the puts should be about a 50 delta. The puts, if this is the call side here, calls are going to be positive, puts are going to be negative, all right? A negative 50 delta, right? Because the idea is everything's on an advancement. So the puts would be going, would be becoming less valuable the higher we move with the underlying. If the underlying continues to move higher, those puts are going to be less valuable, right? Well, because the puts give you the right, but not the obligation to sell that stock. Well, if the underlying is going higher, you don't want to sell the stock, so the value of that put goes down, or the probability of you needing that put is less likely. So on the first dollar move, now XYZ moves higher by that dollar, and we're at 101, so we've moved higher. What would happen is these options, let's say the calls are $1.50 at $2, and let's just say the puts are $1.50 at $2 also. To start off, Well, that first dollar move higher, now we are at 101. Well, these options would increase by 50 cents. So then the calls would be $2 at $2.50, right? The puts, on the other hand, because we moved higher, right? We got a positive move plus a negative delta. A positive plus a negative equals a negative. So we move higher by that dollar. Now the puts value would be $1 at $1.50, right? Because it lost 50 cents on that dollar move higher. Now, I like to look at delta as a lot of things. On the floor, we used to say delta was data, all right? Delta gave you all kinds of data. A 50 delta means it's a 50% probability of finishing 1 penny in the money at expiration, meaning that underlying that stock, that strike you're looking at, when that option expires, all right, that at the time of trade, at the time you put that trade on, if it was a 50 delta, it's saying you have a 50-50 probability of being in the money at expiration. The puts are saying the same thing. You got a 50-50 probability. What's a 16 delta tell you? You got a 16% probability of finishing 1 penny in the money at expiration. A lot of folks talk about those in the money options, and those guys are always touting, hey, you got that big delta, and they're talking about this dollar move higher will actually make you more money. Now, I've debunked that whole thesis a lot of times. Let me let these dogs out. I don't know what's happening. Can somebody help me out with the dogs? I'm sorry. I hope this does not continue very long and I can get one of my kids out there to wrangle them. All right. So back in the saddle again. All right. So delta tells us data. A 16 delta, 16% probability of being in the money. 85 delta, 84 delta, whatever you want to look at, has an 84% probability of being in the money. The problem is with that 84 delta, it's got an 84% probability of being in the money, but only by 1 penny. So if you bought it deep in the money and it finished 1 penny in the money, woo, probabilities were right. Yeah, but you lost a lot of money during that phase. So please check out some of those videos on when I'm talking about buying long calls and stuff like that, because I debunked that, generally speaking, in that. So delta is your probability of being 1 penny in the money at expiration. But on the floor, we used to say 2 times delta equals your probability of touch. All right. Meaning during the life of this option contract, and the underlying is moving higher and lower at any given point, you have 2 times that delta of being touched. A 50 delta, what is it? Oh, it's 100% probability. Why? Because it's trading at the money. It probably already traded that strike. The in the money ones, well, they have a really good probability of being in the money. Yes, you're not really supposed to go over 100%, but hey, it is a really good probability of being in the money. Really affects, this really is in regards to the out of the money options or the at the monies. So like for instance, a 16 delta option, whatever that strike is, 2 times that times 2 equals 32, right? So 32% probability of touch. Those are much better odds. So the idea with my teaching, I guess, is that when you've beaten the probabilities, that's the time to walk away from the table. All right. You know, there's time to count your money and there's time to walk away. That's the time to walk away and count your money. So I like to beat the probabilities, and then that's when I pull the ripcord on it. I don't want to try and get that 16% probability in my favor. I beat the odds. It goes up there, touches my strike. I'm likely to cover like a long call or something like that. Then we have gamma. All right. Gamma is one of those ones nobody really talks about. But gamma is on the increase of dollar number 2. So we got, now we're looking at 101, and usually gamma at these at the monies is somewhere around 5 cents. Depends on the size of the underlying, but it's not a massive coefficient. But gamma goes with delta on that second dollar move. So we saw delta increase by 50 cents on that first dollar move. Now gamma goes with delta on the second dollar move and goes into those options. So we've got 5 cents coming in here, right? So now that first dollar was a 50-cent move. Now it's going to increase by 55 cents. So our trade would then increase to 255 at 305, right? On the flip side, gamma goes with delta on the puts as well. Well, we've got a negative number there, right? It's a negative 50, and gamma is positive. So gamma plus delta is now going to be negative 45. So this would decrease again, and we would be looking at these options to be trading right around 45 cents at 95 cents, right? 55 cents coming out of the puts, all right? So the puts are going to, the deltas automatically start going down the further out of the money they are. I mean, that makes sense. That's what we're talking about. The calls, the closer and closer they get to in the money or go in the money, then those calls should increase due to gamma. Flip side, guys, if we were, this should have been a 102. Flip side is if we start going down, right, a negative plus a negative put, right, well, that would make it positive to the position. A negative move plus a positive delta would make that then a negative delta to your position. Okay. And then we have the thief in the night that comes and steals your premium. You know, in the options montage page, we call this theta, but don't mince words there. He is trying to steal from you. And it's not like he comes and it's not like he's taxing you a normal amount. It's not like 5% every single night or 1% or 0.5%, right? What happens is way out in time, way back there in those really long duration options, theta is very benign, or maybe taking a penny at a crack. He doesn't really know, a penny a night. He doesn't really know you're there. But the closer and closer to expiration, he gets really aggressive, like literally taking fistfuls of cash out of your pockets. All right. So it's not linear. It's not binary. It's a bit of a slope where we see it start out kind of slow, and then it'll slowly increase and then really drop off. Not a very good representation, but really starts dropping off. And this is usually 7 days to expiration. All right. And where this starts picking up momentum, that's usually right around 35 days to expiration. All right. That option montage expiration. So we'll say you can stretch it out to about 45 days to expiration. And this is your sell zone, right? Because we've got that big, massive drop. Is 105, my math off there? 55. Well, 55 cents coming out of this should be 95, right? Because remember, we dropped 50 cents on the first put, and then we're dropping 55 cents on the next one. Okay. Good question, John David. I love how you're thinking. And then out here, we have another little line in the sand that I like to talk about is 70 days to expiration. So this is a sell zone because we really want that massive theta decay. And out here is our buy zone. All right. Because this is where theta isn't super aggressive. Now you can go way out here to 500 days to expiration and you're going to see even less theta. Yeah. You're going to have to put up a lot of capital to do that though. So I've kind of found the sweet spots, 70 days to expiration, maybe a little bit further out, 70, 80 days, but that 70 days to expiration is a real good sweet spot for your price, how much you have to pay for all these things. And that theta component really doesn't ramp up. You go back, say 130 days, the theta differential is not going to be that much. All right. Inside of here, you're going to see like on a daily basis, these options increase. And here we have pretty close to those, what we were talking about. I got 60 days inside of 30 days. And then, inside of that 7 days to expiration, and even go further back to 94 days. All right. And we can see from 94 days, you move in, what is that? Almost 30 days, right? How much does this volatility increase from these at the monies to these at the monies? 2 cents over 30 days. So you wouldn't even really notice that increase too much. Oh, okay. I'll take a look at it. And then the next 30 days, right? From 66 days, that's even more than 30 days. How much does it increase to 5 cents? So this is kind of that area I was talking about. You know, you want to kind of pick. It's inside of 60 days. I probably would roll out to the outside, but it kind of, it's going to be a toss up for you. Doesn't really increase much, maybe 5 cents over the course of 30 days. What happens over the course of this next 30 days? It goes from 17 cents to 79 cents a night. All right. So when we're talking about, the 45 cents on that. When we're talking about this theta, do you want to be buying these options on the calls and the puts? We can look at it over here on the put side too. The theta, it's going to increase at about the same rate there, right? So we can see that theta is really starting to get aggressive the closer and closer to expiration. All right. So we want to stay away from this. That's why I like to say that inside of here is where you're selling options. And out here is where we are buying options. Yeah, folks, it is a little bit more expensive than getting inside of there. You know, it's $15 versus $10 or whatever for the calls. The puts are very similar. So when we're buying, though, it feels like you're buying cheap. Yeah, I can afford this, but you also have to be good stewards of your capital. You don't want to just throw this capital away, right? You worked hard for that money. So go out there. Yeah, you got to put up a little bit more money, but you are going to hold off on that theta component, right? And then Vega is, as you can see, is always positive because, like I said, it's based on an advancement. If volatility goes higher, all of these options increase by the coefficient that is correlated to those options. You can see the further out of the money options are affected a little bit less than the closer duration options. At the money options are affected more so than the out of the money options. You can see here on Vega, the further duration ones have more of a volatility coefficient than the ones closer to expiration, 3 days away, right? Why do you think that is? Do you think it's due to fear, an unknown? If you do, you're right. The further away, 90 days out, 3 months from now, do you really know what's going to be happening? You might have a decent idea, but anything could happen in 3 months. What about 3 days going into the weekend or whatever? I did take this snapshot a couple of days ago. Some of you guys might be like, hey, Wolfman, options don't expire on the weekend. Well, you're right. I took a snapshot of this the other day because I wanted to see if NVIDIA got a big move in either direction. Hopefully by the video, we didn't get it. But the example is still very good for several reasons. So further duration options are affected by volatility more so. So when you're buying and that volatility really spikes, you get to take advantage of it. You don't really want to go out there and sell that high volatility because you want to get inside. Volatility, when it craters, is going to help you in your position, but you also got theta on your side, all right? So that's why you want to break these out to the sell zones and the buy zones, all right? So let's get into this trade. We're looking at the long straddle. Now, the long straddle is a pop or drop. We're buying the two at the money, or the two closest to the at the monies that we can find, and we're going to buy both of those. That way, if the market spikes higher, well, we get to take advantage of that to the upside, and if it falls out of bed, we get to take advantage of it to the downside with puts. So with this one, I guess I picked the ones that are a little bit out. I know what I wanted to talk about this real quickly before we got on. When we were talking about skew. we can see, well, these ones that are at the money with just a few days left, the at the monies are pretty close to 50-50. We can see the 60s probably should have been 50-50. They're a little bit off. But the further out we go, we can see this skew really happening. Like these are the 70 options, and they're the 70 calls, and those are almost at a 50 delta, right? Look at these in the money puts. These in the money puts are not bigger than the necessarily 50 delta. They should be. They should be in the 53s, 54. So what we were talking about skew, this is a product of a lot of the Bitcoin traders are getting into this because it's a lot cheaper, and the options are a little bit better as well. So there's a lot of options traders coming in here to trade these markets, and a lot of times they haven't done the cracking the code to trading options, so they're going out there and buying options here and driving that price higher. I think I just advanced one and I didn't want it to yet. So this is where I was using that as an example. Some of you folks that were in on that video yesterday, there you go, or last week, you can see that these in the money, there are skew to the upside, meaning there is bullish sentiment in this underlying. Now, does that influence my decision? No. As a matter of fact, I'm more of a contrarian. So when I start seeing stuff like that, I'm kind of like, you know what, people don't know what they're doing. And that's when you still have to sell those options. You know, they're buying them up. You got to sell options because they aren't thinking. When fear comes into people, they don't necessarily think about value. All they're thinking about is I'm losing so much money here or there. I got to buy puts. And believe it or not, people are doing that right now too with the VIX where it's at. Could volatility go a little bit higher? Yes. But what is the likelihood? It's likely that when we find this bottom, that volatility is just going to crater. Anybody who is buying options and that volatility craters on them, when we've seen this historical volatility, well, they're going to be left holding the bag, and that volatility is going to crater on them. They're going to not even understand why they lost money. They're going to think it's like theta or something, possibly. But here's the one with a little bit of a skew. Now, when you're doing this trade, I said buying is right around that 70 delta option, 70 days to expiration. The option's right there at the money, the 50 delta. So I pretty much picked as close to the 50 delta as I could, despite the fact that that's not necessarily exactly at the money. Ron, he was there. See, Ron, I'm always thinking of you guys. So there's your example of skew. And really, this was determined by folks buying options, and nothing against crypto traders or anything else, or even the Robinhood guys. But the fact of the matter is sometimes they just aren't doing things that are logical, right? And are you guys starting to feel this? I mean, is this becoming more logical to you, how these options work? Hopefully I'm able to get you guys to a level where all of a sudden it's not about these things like moving all over and understanding. It's becoming logical. Delta is data. It gives us probabilities. It tells us how it's going to change the pricing. Theta is just that thief. And I know that thief just wants to take everything out of my pockets before this option goes off the boards, right? And Vega is just volatility. We see volatility moving higher. We can see then that pricing, when it's at those extreme levels, when this volatility coefficient is up near 63 maybe, that could be very high. Then you look over at Tesla, that 63 could mean it's very low. So we need to make sure we compare the apples to apples, right? And with this one, picking those at the monies, we can see it's $32.35 for that. It will be cheaper than if you go to the next option contract out in time, which is the September. So I've kind of left the lines up here, added the September trade here using the same strikes. So you can see it is a little bit more expensive. But remember, we're losing 10 cents a day on the puts, 10 cents a day on the calls. Whereas the further in you go, you would be losing an extra nickel a night. So that's a reason why I'm leaning to move further out in time there, take advantage of that slower theta decay. We also know that volatility affects those further duration options more. if I get volatility spike on a pop or drop with all of the crypto traders, if Bitcoin starts moving higher, folks, those guys are going to be coming in and buying calls like they're going out of style. And if it starts free falling, they're going to do as predictable as that and buy those puts. Well, they might not as predictably buy those puts because they always believe it's going to go up. But that would be my expectation, is folks would be going in there and buying puts, taking advantage of that downside. Counterintuitive to probably what they should be doing, or it will at least help me out in my trade by buying these both at the money options. So 38.75 is what I decided. Another reason why I picked that, if I can find my chart, the reason why I picked that September contract also, not only did I want to skip the theta decay, you know, this is where the thief is. Stay away from that. We don't want the thief. So we'd go into somewhere like this, right? But one thing we know also about options is fear drives price, right? So what are some of the key fear factors when you're trading? What are some of those big unknowns that we have almost once a quarter, right? We see volatility wanting to spike heading into different earnings events. You can see that volatility was driving higher into that earnings event and has a tendency to come out after the earnings. Coming into this earnings, we saw the volatility spike. What's happening? Comes out. What are we doing now? Well, we're heading into an earnings here. I believe this is my line in the sand to the downside. I think volatility is going to move higher based on a earnings. Now, this earnings is not going to really affect those options that are preceding it, right? Because they will be done before the earnings comes out. All right. So that volatility isn't really going to, it could affect it a little bit, but it's not going to affect it like the options that have that earnings in them. So that's another reason why I went out to the September versus the August, or was talking about those September versus the August more so on that one. So when we were looking at this trade here, that's why I was more interested in these September contracts, because when that earnings comes around, we expect this volatility to spike a little bit because of that unknown, that fear around those earnings. What is NVIDIA going to say at the earnings call, right? That is a fear. What are their earnings? Nobody really knows. We all have a pretty good idea, but not really everything. They could come out and say metal prices are killing us. So we'll have to wait for that, but heading into it, it's going to want to spike. Now, with this strategy, taking advantage of that volatility increase, you want to pull the ripcord on it before that earnings happens, all right? Yes, sometimes that move can make you a lot of money, but most likely it's going to make that move, but the volatility is just going to crater afterwards because there's no more unknown, right? We know they're doing good. The only unknown is how high is it going to go, right? Or how low is it going to go, depending on crummy earnings. And I have a feeling we're going to see more crummy earnings coming out than better earnings. So let's focus in, like strip back this onion, narrow down to what we're looking at here. And we can see that I ended up kind of playing around with it and went towards those 60 deltas because, you know, I'm feeling like that is actually the at the monies. The 65s are the ones that look like it, but we know those at the monies are the 60s. So that's what I was going to do. Plus, I'm also more neutral. If you were more bearish, then maybe you would go up and do the 65s. And if you're more bullish, you would be buying the 55s because, you know, you want to retain that value in the calls. It goes higher, it's going to retain that value. And the puts will lose it. So you would retain here and lose less money there. So if you have a little bit of a lean, like I'm leaning towards, I'm more bullish, like I think it's going to go higher, but I'm worried about the drop, then if you think it's going to go higher, I would be doing these more in the money options there, right? Because you're buying and you want to retain your value. This is the one you could lose money on. But if you thought it was going to go down, then you would be buying these 65s here, because those 65s are more expensive. You're buying a put, you expect it to go down more so than up, but you want to protect yourself. I'd be buying those 65s, right? I'm going to go with the at the monies right there, because I really don't have a clue of where Bitcoin is going to go. Why did you choose the at the money 65s and not the 65s, which is closer to the current price? Well, in this one, I did end up going with the 65s because I was just going to go with the at the monies, and I am more neutral here. All right. So you can see the pricing is very similar. Yeah, the skew is off a little bit. 65s are a little bit out of the money. I don't have as much of a directional move. Yeah, those deltas are 50, closer to 50 there on these 65s. But if the market were to go higher, I'm going to have to make up a little bit of ground there to get this pricing. This one's going to start dropping. This one's going to increase, but I only paid $16 for this one, and I paid $22 for that one, right? If the 22 starts losing money, that would hurt. So that's why I went with the 60s, closest at the money. My pricing is very similar. If you have a bit of a bias, then you can cheat it out a little bit, all right? And then you can look at your risk reward. This is a defined risk strategy. Anytime you're buying options, folks, you know your risk, and that is going to be that $38 in this case. One thing you have to know is your break even on this is going to be pretty wide. So you do need to have a good solid move, and you really want this to happen relatively quickly too. But you basically take the $38 there. All right, got it. $38 there, add it to the calls, which we're doing those 60s. So plus 38.20 brings us here to what is it? 198.20 is your break even there. To the downside, you got my check out there, guys. Make sure you guys are checking this math here. So to the downside, I believe it's like 120. Is it 121? 80. Is that right? 121.80 would be your break even to the downside. So you do have to make a big solid move. And keep in mind, folks, this is at expiration. All right. Remember, 1 penny in the money at expiration. The analyze tab here is based on expiration. You have to at least get there. You have to make up that distance on that put to the downside to get $38 lower. All right. To the upside, I got to get $38 higher. But remember, I was talking about probabilities earlier. You get that move quickly, you're going to see this strategy work out much faster. All right. So you're going to want to get out of that, especially if you saw the volatility spiking and this underlying doesn't really move. That might be an opportunity to get out also for a profit. But this is, like I said, at expiration. You don't always have to get to those levels in order to be really profitable, right? Break even is, hey, I didn't make money or lose money. Well, no, you don't always have to get there. Another reason why I want to buy myself a little bit more time to be right before I get into that theta zone. So if you got a big move and it moved up to, let's say, 185 tomorrow, you would see this strategy be very nice, right? It would work out quite nicely if we got a big move, $20, $25. And that is not unheard of for something like NVIDIA. That can do that overnight. So we could get a big move overnight. I'm not necessarily going to make sure it gets to my break evens. I'm going to cover this strategy for about a 50% increase in value. I might even take 25% increase in value because, that would be basically $10 if it was 25% increase, right? So when this trades around 48, 49, that's when I would look to try and cover it on, especially if I was newer to trading options, right? Going to lower probability of success here because we have to make such a big move. But if that starts all happening, we start getting that move, we get that volatility increasing, we are going to see this strategy increase by 25% really quickly. So just to get our lines in the sand here, I think the break even to the upside, what did I say it was? 98. So our break even to the upside on the chart, I don't want any of that, is kind of right around above the point of control there. I always say that with a point of control, that's going to be acting as a magnet to get it to drive there. And to the downside, you know, we're below that value area. If Bitcoin starts rolling over, the next stop is, I don't know, we could figure it out here. I'll pull up, hopefully the platform's working. So here's our chart. It hasn't really gone anywhere. Volatility has started going back up a little bit. But if we want to find another level as to where this is going to go, I need to kind of drag this 134 there. That's going to find some support. 129 is just below that. So will we get to that? I don't know. If we came down there and slammed this in the next couple of days and hit off of that, that might be the opportunity for me to get out of this strategy, right? I don't need to hold on to anything to the end of the day to try and prove myself to be right. If it goes down there, beats the probabilities, that's what I'm looking to do. As a matter of fact, if we went up and hit this one, I'd probably look to cover it there either. Also, I'm not going to try and be a hero here. Won't the stock go up beyond the break even if volatility drops right? Well, I think what he's saying, won't the stocks go up if the stock really starts going up higher, gets back up into this area? Volatility, when in markets that are rallying, volatility does have a tendency to come out. I don't know if we're going to see that anymore. We can see during this rally, we got that volatility rising. It used to be that we used to say in rising markets, volatility would fall, and falling markets, volatility would rise. But that was because in rising markets, people were doing covered calls, and in falling markets, people were buying puts. Well, now people are trading options left and right. So volatility is pretty consistent across the board. We get big rallies, we start to see volatility spiking. We get sell-offs, we see volatility spike as well. So those are the two places I would be looking to cover this trade. You can see we're right in between that almost exactly. So 2 lines in the sand, not at my break even, but we get a move there, then I'm going to be looking to cover it because I've beaten those probabilities. All right. You know what you could even do? We could go back to what was I going to say? What is that? What are those numbers? Let's call it 85 and 34, right? So 85 and 34, we go over here. We can look at our 85 and 34 to see what those probabilities are on our trades. So 35 is a 25% probability, right? So I have a 25% probability that the underlying is going to go down and hit that support level. To the upside, the upside, I can't close this. Sorry. To the upside, you know, the idea is it's probably going to be about a 25 delta as well. So what do I have there? 2 times the probability, or 2 times the delta is the probability of touch, right? So I've got a 50% chance that I'm going to hit either one of those support levels, support and resistance. 35 is that support, 85 to the upside. I've got 50% probability of touch during the life of this underlying. I'm going to pull the ripcord on that. That's pretty darn good opportunity or probabilities. What's your downside line in the sand if NVIDIA doesn't move? If my downside, what is, like, are you asking me what is my, where would I pull the ripcord to get out of this trade? Like, would I get out of it at, as a loser, if we just start trading sideways and I'm watching theta? I'd probably get out at about a 25% decrease, especially on something like this. I have a friend that has a time stop. His idea is when he's looking at the charts, he sees something, maybe a consolidation, trading indecision. That's when he's expecting the pop or drop, or I would too. But he says that if I put this trade on here and I go 5 days without breaking out, I'm pulling the ripcord. I don't care what the strategy's done. If volatility has gone through the roof during that time, the underlying hasn't moved, he's still pulling a ripcord for a winner. And volatility goes down and he's losing money. After that 5 days, he's still pulling a ripcord. So a time stop is a good one, because if it's not making the move within your preferred time, it might not happen, right? Like things start changing. For me, I look at a percent reduction. Usually on something like this, I'm more of a 50% reduction to get out, especially on something as long-term as that. All right. So that is a bit of a gray area. You have to do a little bit of self-reflecting. You know, what's my risk tolerance? If you're one of those folks that has kind of already told yourself, I'm going to wait for those last quarter areas for the volatility that we talked about, whether you're buying or selling, then I would say that you'd probably lean towards the 25% rule, or give yourself a 5-day rule. You don't start seeing real marketable moves in this underlying, then we're just going to walk away and agree to disagree. Does that answer your question there? Okay, good. So I would be trying to play it between those two areas there. All right. Oh, I did a little bit of review, but here you go, guys. While we're here, I'm going to throw this up there for you. This is my course that you guys can take advantage of. You guys will have unlimited access to this because you guys can watch it time and time again. It never goes away. There's over 15 hours of content. And the one that I talk about the most, like anybody a little bit worried about what's happening as of recently. I don't know why this can't find my pen. Oops, I don't want that. Here's my pen. Rising interest rates, right? We just saw them increase interest rates again. As a matter of fact, it was a global concerted effort. Rising interest rates. One thing I talk about this is what happens when interest rates rise. Not only does it make it more difficult for you to buy a house because you got to put so much more money to that mortgage. Well, when interest rates rise, what happens? Price falls. And it doesn't necessarily mean, I mean, you heard me talking about gas. You talk about other products falling in value because interest rates are rising. The Fed is trying to keep you to hold on to your money or be a saver. Well, the other thing is we say with a teeter-totter is these are bonds pricing, right? Yeah, if you hold a bond for the duration, you will get par back. But in the meantime, if you bought a bond, and most people have somewhere between 25 to 50% of their portfolio, you and I, in bonds, all right, or at least government securities. So if we see a increase in interest rates by 1 percentage point, a 1 percentage point increase in interest rates causes bonds to go down. Why? Because everybody wants that higher yield bond, right? But you can't sell your bonds and run out there and buy a higher yield bond because you're selling your bond for much lower than you bought it, and you can't make up for the higher coupon. It just doesn't work. Traders are savvy to this, folks, and they're not going to let you do that. They're going to be buying your bond super cheap and say, all right, I'll just hold on to it. And that par value that I get as a return will make up for my deficiency in the interest rate that's being garnered right now. I'll make up ground, okay? But what's happening in your portfolio is it's reflecting the value of bond pricing. So as those interest rates go up, I think 1 percentage point increase, the last time I did the math, that basically was on a bond portfolio of $250,000. After that 1 percentage point increase, that value went down by about $50,000. All right, so that's painful, especially to a portfolio. So make sure you take advantage of this to lower your cost basis on those bonds. And trading around the market profile, this is one of my favorite things to trade because it tells you the psychology of the market. It tells you where people find value. You know, I talked a lot about value today with the multiples on stocks, things like that. Well, the charts can show you where value is being discerned. This is a Netflix. You know, we got a gap. Well, there's no value there. Nobody wants the price there. But we could see that this was where people accepted value, right? This is where people are definitely accepting value at 192. That's where people are trading the most. And I always say that tells us what most people are thinking is value. So we can trade around that. We don't want to trade that tick because it's probably not going to do anything. Everybody who's traded that price already is kind of sitting on their hands like, is this ever going to move? All right. So don't necessarily get involved there. We like to do it on those extremes. So that video on protecting your portfolio, or trading the market profile, that one's the one you want to take advantage of. I also show you how to set up your screen. You can get the script to be able to do the 6-month implied volatility percent, all that good stuff through using this one video. Plus there's some fun ones in there talking about who invented the options. And we'll let that cat out of the bag in that video. All right. So please take advantage of that. I appreciate you guys all sticking around today. And I hope you guys have some takeaways. If you did, if anybody had a takeaway, throw a Y over there in the chat window. Let everybody know that you guys had at least one takeaway. Maybe it was on the delta thing. 2 times the delta is the probability of touch. I'm going to use that to determine when I'm getting in and out of my trades. If I buy a 16 delta call, it goes up there and trades that strike, pull the ripcord. You don't be a hero because you only still have a 16% probability of being in the money at expiration. All right. So don't try to play those odds that are going to go against you in the long run. All right. Thanks again. Like I said, appreciate you guys all. You drive the content. We're both here on YouTube and on Facebook. So I know that there's sometimes difficulty in commenting, but I'd love to hear what you guys have to think. I will also circle back around, folks, for you guys that didn't get a chance to watch this live, to see if you guys have any questions, comments, or anything else to drive the content going forward. Like our boy, our guy Ron over there, who was talking about skew last week, and we ended up kind of adding that layer into this video as well. All right. Take care, guys. Make sure you subscribe. Smash that like button for me, please, because that feeds the bots to go out and share this content with somebody else that it thinks looks like you. Can't take that? Take it easy. Bye for now, guys. See you tomorrow.